Welcome to Closing Remarks. My name is Dara Shareef, and I am your host. We're going to try something a little different today. We're going to do a Q&A session, and I have with me someone who has been with us for 6, 7 years, something like that, perhaps
Think we're
more.
going on
Yeah,
10.
10
I
years.
think we're
Wow, I
going
had to
on
get
10,
6,
which is
7 in there
crazy.
just
Yeah.
to make my kids hate me even more. I'll probably get shanked at night tonight. Bringing on Kayla. So Kayla, we came let's see, she came in as an analyst or an associate and ascended all the way up to running our transaction support team. And then we brought her into our sort of back of house, our central support team, and she's one of our ops leaders. So Kayla, say
Yeah.
hi to the audience.
Yeah. Hello, everyone. Yeah. Thanks for having me on the pod, Dara. Yeah, like you said, I'm operations director now. Started here, yeah, almost 10 years ago, which
Wow.
is crazy to think. I can remember like it was yesterday, starting as an analyst and being like, what am I doing? What am I getting myself into here? But yeah, I've worked on, hundreds of transactions, supporting financial analysis, due diligence, running the transaction support team, and now in my more current role as operations director, kind of working on, operational strategy and process improvement as we continue to grow. So it's been a journey. Glad to be here.
It's been great to have you. So she's in early, she's here late.
Yep.
She's really grinding. So it's really a pleasure to have Kayla on the team and to have her on the podcast. So here's what we're trying to accomplish today. It's a little different format. So typically what we do is we bring in business owners, their advisors, and we're speaking to the other business owners. That's our audience. Their spouses, their influencers, and we're trying to demystify this complex language of M&A,
Mhm.
right? That's what we're trying to do. So usually we do it through other business owners, those who sold a company, a buyer, perhaps one of their advisors. And one other way to do it is to take their questions directly and answer them. So that's what we're doing today. You're kind of the avatar for the audience. I am the so-called expert. We'll see. Maybe we'll evaluate me at the end of this episode. But that's the idea of the pod today. So please go ahead and kick it off. What's your first question, Kayla?
Sure. Yeah. Yeah. There's going to be some common questions that we get that I'm going to throw at you. But first one is, what is EBITDA and why is it used to value businesses?
I get this one a lot. So I've gotten this question for as long as I've been, I think, sentient. So EBITDA is sort of an accounting convention. So you don't really see it on an income statement, right? So what we do is and I know Kayla knows this probably better than I do. So maybe I should turn it over to her to answer this, but I guess it's my gig. So you start with net income, which is sort of at the bottom of your income statement. And you start adding things back. And I'll talk about the things you add back, and then I'll get into sort of why. Right. So net income is also a function of things that are not necessarily cash items like depreciation and amortization. So if you go buy an asset and it's got a 10-year useful life and you accelerate depreciation, you're doing it so that you can reduce your taxable income. It's not a cash flow item. It doesn't impact cash at all. You've already spent the cash on that piece of equipment. You're accelerating depreciation just to reduce your tax burden to the government. So it's not really a good use to understand, sort of what the cash flow profile of the business is. So we add it back. Same with the amortization. It's kind of the same thing, but for an asset that is not tangible. So like think of like IP or something like that. So taxes and interest are a little different. So we're trying to evaluate companies on sort of a normalized basis. So we want to get rid of like capital structure, and we want to get rid of sort of ownership and even kind of where they operate. Right. So taxation is a function of how you're set up as a corporation. Are you a C Corp, an S Corp, an LLC? It's also a function of where you operate because you have state taxes or you don't, right? Depending on where you are. So we're trying to create sort of a neutral playing field. The same thing in terms of how you finance your company, right? So if you borrow money to buy equipment, you've got interest payments. Well, a buyer doesn't really care how you do it. They want to take capital structure out of it because they want to compare your business with another business, right? Now, if you do borrow money, understand that you're going to pay that off at closing. So you might get sort of a higher income level, attach it to that multiple, but then you're going to back out the debt, right? You've got to pay for it at closing. So it sort of neutralizes it. But that's the idea, is to put everyone on a neutral playing field. So why do we use it? We use it because it's a great proxy, a simple proxy for cash flow. So buyers can put, this business over here and this business over here and sort of compare them and say, I like this one, not because of the EBITDA, but because of all these other attributes. And they can compare and contrast. It's also sort of the common language. So lenders understand it and they use that as, hey, we're going to put 3.5 times leverage on it, which means we will loan 3.5 times EBITDA on this deal. Right. So that's what it is and sort of why we use it in M&A.
Yep. And then, you mentioned that the debt would have to be, paid off. So that's also something that I think we hear a lot from sellers of kind of a misconception,
Yeah,
maybe at, time of close of saying, okay, the debt has to be paid off, but something, common term is kind of cash free, debt free as well. So maybe if you could just hit on that quickly
sure.
as well.
Absolutely. So yeah, that's a great follow-up. So yeah, as I said, when you're borrowing money, the idea is you have that cash that you have on the balance sheet and you can actually use it to do other things, hopefully to create even better earnings profile. So you're going to have a higher earnings stream, but you also have to pay off the debt because the buyer's not going to be burdened with that debt, right? So and you can't really convey an asset without conveying the debt unless you pay it off,
Yeah.
right? So it's a complicated thing. So usually you pay it off, and the cash is an asset that you've already paid taxes on. A lot of the cash in our clients' businesses are really not operational cash. They don't need it. It's sitting there. They don't really need it. It's there as a shock absorber. So what we see is a distribution of the cash, a swiping of the cash a couple days before closing. It's theirs. It's not, you don't buy cash usually. You know, what are you buying cash for? I mean, you're going to re-inject cash into the balance sheet afterwards, sure, but we don't see that very often. So most deals are cash free, debt free.
Yep. Nope. It makes a lot of sense. Feel like it just comes up, a lot in
Oh
the
yeah,
process for
sure does.
sure. And another kind of term and group that comes up a lot is private equity as well. And I think a lot of sellers and lower middle market often have misconceptions about private equity. So can you just explain what private equity is?
I can, and they do, and a lot of it is earned, right? So think back to years ago, private equity was sort of a financial engineering platform. They'd go find a company, they'd lever the hell out of it, right? They'd sort of use their balance sheet and their own balance sheet to like create an incredible amount of debt and sort of like financially engineer a way to profit, right? So that's gone. We don't do that anymore in this industry. Now what they're trying to do is actually buy good companies, grow them, and sell them for more than they paid, right? But at its heart, private equity is a pooling of capital. So you have a GP, a general partner, which are folks like you and I who decide, hey, we've got this idea, we want to raise money, and we want to attack these kinds of companies and buy these kinds of companies. And then you have the LP, which is the limited partners. They're the investors, the ones who have lots of money and they give you money to invest on their behalf. Typically, we have institutional investors, right? So you think of insurance companies, college endowments, you think of, retirement funds of large institutions and sort of rounded out by high net worth individuals. And they pool capital and you, the GP, you invest it on their behalf. Funds have like a 10-year useful life with extensions. But the first 3 or 4 years you're investing, you start harvesting. And in the midst of that, you're actually raising the next fund, right? And the idea is you use a portion of the fund, usually it's 2% every year, to pay for your operations. And then at the end of the day, hopefully you sell businesses ultimately for way more money. That is the mandate. These guys want their money back. These are not buy and hold scenarios. 20% of the proceeds go, after all expenses are paid, to the GP, the managers. 80% of the profit goes to the LPs, the investors, right? So the 20% is called carry or carried interest. It's taxed differently than it probably should be. And that's a big debate that has been going on for decades and decades. But right now it's taxed as long-term capital gains, which is an incredible hack, which is why everyone wants to be in private equity. So that's sort of how private equity works. It's a useful life. They have to sell. As soon as they make an investment, they're already thinking about selling it. That's sort of the difference.
Yep. So, from a seller's perspective, I know when working on transactions, I would often hear from sellers sometimes avoid private equity firms or
Yeah,
I don't want to work with them. How would you answer that question, for sellers that maybe have that misconception about working with private equity?
that's a great follow up. So I would try to get to the why behind it, right? So a lot of them think that, hey, these guys don't understand my business. Usually that's actually not true. So oftentimes they'll have sort of a thesis. They might even have an operating partner who's been in that industry and really knows it. They've written white papers, they've done all the work. So they actually do quite know that industry usually pretty well. If that's the reason, I can usually assuage them of their concerns. If it's something along the lines of say, hey, they're just going to cut my my head count, they're going to get rid of my employees, they're going to they're going to change the name. Usually you can also get out in front of that as well, because generally they are backing management teams now, right? So they're buying something. It has inherent value, and a big part of the value is the team. These aren't operators. They want to come in and sort of inject jet fuel, capital, governance, a Rolodex, and help you grow. They're not looking to come in and run the company, right? So they're backing teams. So if that's, I can usually get out in front of that as well. Now, if our client wants to sell 100% and get out, that can be a challenge because private equity funds almost always want you to retain a piece of the business. And it's they're confirming their diligence and making sure they got it right when they were doing due diligence. They also want to back people who sort of see the future, right? You say it's going to be a great growth story still, like back that up, keep the peace. So, we see that as well. So, folks who want to sell 100%, it may not be a great fit. But those who want to preserve their culture, it actually is usually a pretty decent fit because a strategic is going to say, well, we don't do it that way. Right.
Mhm.
Right. And we've seen that. I remember talking with our client at PBK, and he got an offer from a large strategic many years ago. And they came in, they were looking at the business. We're like, well, we wouldn't do it that way. And we wouldn't do it this way. And our client was like, well, that's unfortunate. We're not going to work together then. Right. And that's not really atypical. That does happen quite a bit. So there are benefits to private equity and there are sort of downsides. The other part about private equity is they are there, they buy to sell. It's going to flip again. These are not long-term holders. So that if you absolutely don't want this thing sold again, then private equity is probably not a great fit. You're looking at strategics, you're looking at family offices.
Yep. And you mentioned that private equity is most often wanting, management to stay on, stay
Yep.
involved, retain some equity. What else do PE funds look for in businesses?
Yeah, it's a great question, and we get this often. So I look at sort of durable earnings, like show me an earnings profile that is durable, that is going to sort of avoid the shocks of Liberation Day and all these sort of exogenous forces that are impacting us, like inflation and interest rates. If you are shown to survive that, that's durability and that's attractive. Sort of like fragmented markets, right? Those that they can roll up. So if there's two big incumbents in the industry and they own 80% of the industry, probably not a great market for private equity. But if it's distributed amongst hundreds of different companies, that is perfect for them, right? So they're looking for durability. They're looking for something that has a founder that is not sort of the heart and soul of the business anymore. So you push down some of the relationships, the functional ownership, decision rights across the whole business. That's a business that has durability and value. You buy something that has a founder that is completely running this thing, you're buying a job. You're replacing that founder with yourself, and now you're essentially a one man band with backup singers. So those are some of the things they look for, and the lens they often will look through this. I kind of break it out into two lenses. One is sort of opportunistic, and the other is sort of thematic, right? So an opportunistic investor is going to say, we like businesses that are asset light. We like them with 20% EBITDA margins, without founder dependence, right? So they don't care about the industry as much. They want to. That's what they're looking for, and they'll say, "Well, that's a good deal. We think we understand that market pretty well. Let's put a bid in." A thematic investor is very different. So they have a thesis, right? They have a white paper they've written. They've got an operating partner who's like, sold the business in this, and they really understand it, and they bring a real angle to the business. And that creates operational leverage that really creates the ability to scale, which is really what they're looking for, right? They're buying low and they're selling high. That is the idea here. So that's kind of what they're looking for.
Yep. And I know you mentioned founder dependence.
Yeah.
That's something that they want to avoid when they're dependent on the founder. But another one that I often see too is customer diversification.
Yeah,
So a lot of clients in lower middle market, it's just kind of the way it is, where
it is.
they could be reliant on a few customers. Is there how can customers and potential sellers prepare, for a potential sell when it comes with customer diversification, for example?
Yeah, it's a great question. I should have covered that in the last one. So thank you for the save there. That was you went to the bullpen and called for
Yep.
the lefty. So yeah, customer concentration is really hard. I mean, buyers really look at that aggressively, and if you're above 30% concentrated, they're going to ding you in some way. If you're 80%, they're probably just going to pass. It's really hard to say no. That is, we get that. So if you got Walmart as a customer and they say we want to give you this PO, you it's really hard to say no because at some point they might change the purchase sort of manager and that person just says, "Hey, we're going to go somewhere else." And you want to stay, in good graces there, right? So it's really hard to say no to when you're little and a big guy says, "I want to give you more business." So that the answer is not to say no to work. It's to invest in your sales force to bring in strategies to go diversify around that big customer. That's really the because otherwise, the only one buying something that's heavily concentrated with one customer is someone in your industry that can immediately mitigate it, right? So you go from a buyer pool of thousands to buyer pool of 8, maybe, right? So and they know it. So when they know it, that offer is going to, shrink dramatically, right? So that's the key. So sure, customer concentration, we say, "Oh, you're too concentrated. Just reduce your customer concentration." Oh, okay, that's easy. I'll just tell, Walmart to pound sand. Well, probably not.
Mhm.
Probably not. But you can put together a strategy to really build around it. To really build around it, and at some point, you might actually have to say goodbye to Walmart, and when that happens, or they say goodbye to you, and when that happens, if they're 8% of your business, it's probably low margin business anyway, frankly, right? So it actually might be sort of a bit of a jump start for you when it actually happens if you've built around it.
Right. Yep, that's a good point. Yep. So, you also mentioned market conditions,
Sure.
which is obviously very important.
Yep.
So, is it a buyer's market or a seller's market right now?
Yes. I'd say yes.
Yes.
So can we leave it at that, or
Yep,
no? Do you want
sure.
more? You want okay? Say more. I'll say more. So I think like any market, this market supports elite businesses. So if you've got a great business, you're going to get a lot of attention. It's sort of a bifurcated market. So like A assets are trading at really high premiums because there's so much capital out there. So private equity funds have so much to invest, so much so that some are actually kind of giving money back. So they're shutting down, saying we can't deploy. It's a bit of a challenge. So they got paralyzed with their underwriting, trying to figure out how to deal with tariffs, right? And all these crazy events that are happening that are impacting supply chains, Straits of Hormuz, you have like anything that's transportation driven, anything that's in the plastics, petroleum sort of market is getting really eaten away right now. And how do you underwrite that? And they were paralyzed for years. Now they're getting better at it, at underwriting risk, but they're really sort of all focusing on A assets. So if you don't have an A asset, it's a little different sort of experience right now. It doesn't mean you can't trade. It just means that it's more limited. Strategics have a lot of money on their balance sheet as well. There's a lot of cash out there, but they're so disciplined right now. So if you've got a great business with a defensible moat, got recurring revenue, all these things that people are looking for, you're going to get an incredible amount of action. If you are, sort of not that, you're just gonna have to work a little harder. It means really having, like, a really thoughtful advisor, someone who was gonna kiss a lot of frogs on your behalf, uncover every single buyer out of every rock, and you'll still trade, and you might trade for a great premium, but you really have to look. So, there was a time, not that long ago, where every asset A, B, C, and D was trading for ridiculous multiples. To find those multiples now, you have to work for it. You just have to work for it. And luckily, we are here to do that. Not everyone uses our services. And, I'm sorry for those folks who don't take advantage of what we deliver. But in markets like this, if you have an A asset, you're going to be in a really good spot. If you don't have an A asset, and that requires really looking at yourself objectively, looking in the mirror and admitting that your baby may not be the best looking baby on the planet and there are opportunities to improve. And, that might mean engaging with someone earlier. Like, again, we can help diagnose some of the challenges that they're going through and help them, sort of craft strategies along the way. And those are opportunities to turn a B minus asset into an A minus asset. And then you really unlock a lot of dormant value.
And which, kind of goes into the next biggest question that sellers
Uh-oh.
always have, which is, what is my business worth? We get that question 15, 20 times a day, right?
We do, and my answer is pretty consistent. So I think most folks would love it to be prescriptive. Like, well, I have this EBITDA, I have this many EBITDAs, and multiply this many EBITDAs by this
Hmm.
number, and this is what I'm worth. It's really not how it works, right? So you value any asset by either its sort of inherent value in a market or by its ability to create cash flow and how many years worth of cash flow you're going to pay for it. That's kind of any asset, right? So in this world, it's really what a willing buyer at arm's length is willing to pay for that asset. That's what it's worth. So what are the inputs? Well, they're going to look at EBITDA, they're going to look at prevailing multiples, and they're going to look at sort of cost of capital, which means how expensive is debt, what's the cost of their equity, what's the availability of both of those things. What else is out there in the market? How aggressively does this solve a problem? What's the synergy? Like, do they have a key to unlock dormant value in the target or vice versa? Even better, the target has a key to unlock dormant value in the buyer. That can be then it doesn't really matter because they have a huge angle and they can really overpay. Right. So that's a big part of it. Frankly, if you've got a fragmented market and you've got a platform, an 8 times deal can go to 10 times because they can buy a bunch of tuck-ins for 5 or 6 times and dollar cost average their multiple down so they can overpay. So the point is 2 businesses with the same EBITDA in the same market doing the same thing can get vastly different offers because of some of the things we talked about before and some of the things that sort of just are inherent to the buyer and the seller. So really the only way to value an asset is to take it to market and find out what the market will bear. Ideally, you take it to market and you get 6 or 7 offers. I did it again. 6, 7 offers, and you work them against each other and find out which one of them wants it the most. And sometimes, again, something like, hey, a fund has been around for 18 months and has not written a check. That fund is going to overpay because they have. So what is that? What is it worth? It's worth what someone's going to pay for it because you might have six offers that are at, I don't know, $50 million. And the one fund who has to deploy capital will pay 75, knowing that they're overpaying just because they have to deploy. So that's why it's not a science. It's not prescriptive. You can't just take a formula and say, hey, this is what I'm worth because the formula said so. You can do evaluation. Evaluation is worth, the probably less than you paid for it. The best way to figure out how you value a business is take it to market and see what the market will bear.
Yep. I mean, that's so true, right? So, I mean, I think from a seller's perspective, I think this was very helpful. Just, these are the common questions that we get every single day. And sometimes, it is an emotional experience for them
It
bringing their
is.
business to market,
It is.
especially in lower middle market. So, just being able to hear the perspective of, hey, not one size, not one shoe fits all, right?
That's right.
Doesn't matter what my business worth. All the sellers are always going to ask that, but it's a very difficult question to answer because it depends on a lot of the things that we just talked about.
Things within your control and things that are not within your control, right? And things
Mhm.
like the market conditions and, the unique point in time. We did a deal. I think I mentioned PBK beforehand. The ultimate buyer passed the first time around. We came back to them and it was exactly a part of their strategic plan. And they said, boom, let's go and
Mhm.
paid the most for it. And by the way, they sold it again and made a ton of money. So it was a great deal for them. Even though, they might have overpaid on the front end, they made it back and, many times over on the back end. So that's right. I mean, timing matters. It all matters. And that's why we're here is to sort of unpack these questions that we get all the time. We're going to do this format again, and maybe have Kayla back and some other members of our team to be the avatar, the stand-in for the audience. And this will be sort of an ongoing series. And we're going to have an email address set up where you can start sending in your questions, and we'll take them. And this should be a great way to sort of supplement what we're doing with guests. But really looking forward to educating an audience that's been largely sort of ignored and left behind. That's why we exist and why we're here. So I want to thank Kayla for coming in and being the sort of the avatar for the audience.
Yeah, thanks
Great.
for having me.
It was
It's
great to
great.
have you here. And,
Mhm.
and remember, in business and in life, the best outcomes aren't found, they're built.